Good morning, ladies and gentlemen. My name is Stuart Taylor from the School of Accounting at the University of New South Wales. And thank you for attending, or at least watching online, my presentation entitled, Are There Fee Premiums and Discounts for Gains and Losses of Large Clients? Okay, so this is a paper where I'm really asking, how do auditors establish a reputation for quality? And so what I'll do is I'll bring up the presentation slides here and share. This is, hope this all works smoothly. Okay, well, let's see. Okay, well, you should be seeing that. Okay, so as I said, are there audit fee premiums and discounts for gains and losses of large clients? And the theory is really quite simple. Auditing is a credence good. Now, what this means is that you can't determine the quality of an audit even after it's been completed. Except in the very rare cases where an audit is proven to be a failure, where there's had to be a restatement or the company collapsed and a going concern opinion was not given, all those kind of things, or where there's legal action. But the vast majority of audits, we never know. I mean, 98% of audits get unqualified opinions. A very small percentage of them are actually end up in, having their quality revealed. And of course, good quality is never revealed, only bad quality. And so therefore, the market struggles to operate in the sense, what the audit market, what the auditors and the clients would want is some way to determine who provides good audits and who provides less good audits, and for the market to be able to price those, so that if you're an auditor providing a very high level of audit quality, that you can charge a high price for that. Or if you want to take the other route and provide low but still acceptable quality and do a lot of cheap audits, you can get a market for doing that. So there needs to be some way for auditors to obtain a reputation for providing high quality audits. And there needs to be some way for this to be communicated to the client so that the clients can be willing to pay for these. Okay, so there's two sorts of information available to the client. The first kind is public information. That comes from advertising, it comes from branding, it comes from networking events, it comes from, talking to people, those kind of things. And so I think, most people would say, well, the big four auditors have a very good public reputation as being better than the rest. But, public information is manipulatable. It's only so good. And, it's also very broad brush. I mean, it's one thing to say, well, PricewaterhouseCoopers is better than, Bob's Shonky audits. But how do you know what you're going to get? If you're a large client, how do you know whether PricewaterhouseCoopers is better than Ernst & Young? So, of course, the other source of information is private information. Now, there's two main ways to get this private information. I mean, the first way is if you're tendering for an audit, if you're a large client, the audit firm will give you a lot of information internally and allow you to meet the people who are going to be doing the actual audit and things like that. And so you can learn a lot from them. Of course, they will put their best foot forward, but still, if you're smart, you can see through them. The second thing is, obviously, once you've had an audit, you've already had experience with this and you've seen what they've done. And there are other forms of private information, but ultimately, I mean, the set of private information is much larger than the set of public information. And the difference, another key difference is large clients have more access to and ability to analyze private information. I mean, they have more access because the larger you are, the more effort the firms will put into having you as a client. And so, if you're a major bank or a mining company, BHP or something, they will really throw a lot of information at you, be willing to answer your questions. Whereas if you're just some small company, they might pretty much say, take it or leave it. And also at large clients, they have a better ability to analyze the quality of the audit. And the reason is, often they've got far more experienced accounting staff, and often they are actually ex-partners and things like this working there. And so they can, they're brilliant at accounting, or, and they are in a great position to analyze information they've been given. Whereas, a small mining company, where they're basically run by engineers, well, they're really going to understand what the auditor's offering or even what it means. So for this reason, there is a public information that's available to everyone. a much larger set of private information that's available only to particular people. And the large companies are in a better position to get and analyze their private information. So if you're a small client, what can you do? Well, what you can do is you can watch what the large clients do, and they reveal their private information by their choice of auditor. I mean, if BHP chooses KPMG over Ernst & Young, that's saying something. I mean, they could have chosen either. I mean, either one of those firms would be happy to have them. So if they chose this one over that one, it must be because they think there's something about this one that's better. Now, you don't know why they made that decision, but you know that they made that decision. Now, of course, some people say that, some firms actually, some clients actually want low quality audits. Now, that's certainly going to be true in specific cases, but I do not believe it is, dominates the market. Just like some of our students cheat, but it's a small proportion. Some clients want bad audits rather than good ones, but it's a small proportion. And to a certain extent, just like we can pick it with our students, I imagine if you're an audit client looking at the market, you can sort of have an idea about which audit clients want lower quality, and you can ignore their choices, unless that's what you want, of course. Now, so public client, large clients reveal their information by their choices. But again, how relevant is that information to you as a smaller client? Well, again, it's going to be more relevant if they're choosing a client in the city where you are, because obviously you're going to have to be audited from your own city. It's very impractical if you're based in Melbourne to be audited from Adelaide. So again, choices at the city office level are most relevant to city office, to you if that's your city office. And again, audit firms differ in their industry ability. So if you're a mining company, you want to know who the mining companies are choosing, not who the retailers are choosing, because retail and mining are different industries. And therefore, the choice of a auditor, in the retail space is not as relevant. It's not entirely irrelevant, but it's not particularly relevant to you, whereas the choice in the mining space is. And again, decisions made by the industry leaders, who in effect put themselves out as being the best, if they're gaining or losing clients, that's telling you something as opposed to just being a run-of-the-mill auditor. And so again, we should expect the relevance of the information to be greater the more similar the gains and losses of clients are to who you are and what you want. So that's the basic idea. And so there's some prior research. I mean, you all know this, so I won't dwell too much on it. I mean, we know that there are benefits to higher quality audits. We've seen it with lower cost of debt, lower levels of IPO underpricing. And the other sort of important point I want to make is about quality. And audit literature has been fixated on D'Angelo 1981, who says quality is solely competence and independence. And that's quality to the market, to the users of the financial information. Now, Duff 2004-2009 has taken a broader view of quality that I've always liked. And he said there are 4 dimensions: competence and independence, like D'Angelo, but he also talks about relationships, experience and expertise of the auditor, and service qualities, empathy, responsiveness, non-audit services. So those second 2 dimensions, or the third and fourth dimension, relationships and service qualities, are not relevant to users, but they are relevant to the client. We would like to have an auditor who's efficient at running the audit, who's friendly, who can offer us advice, these sort of things that D'Angelo ignores. But clients are willing to pay for. Remember, it's the clients and the users who are willing, it's the clients, not the users, who pay. And, some of the benefit is, the clients are paying for the user's benefit, but they're also paying for their own benefit. And so this is why, if you're talking about auditor choice, I mean, concentrating just on, well, they have an incentive to do this because they're doing an IPO is not the full picture. And so every auditor has an incentive to have a higher quality audit, even if that really is from their own internal purposes. Okay, we know audit quality is large in terms of the office level rather than the firm level, and we've got a bunch of research there, going all the way back to 1992 and most recently in 2013. Francis and Mikos have shown that low audit quality is contagious across clients at an audit office. That to a certain extent, you can be an office can be contaminated. You start doing a couple of low quality audits, it spreads across that, and that's why the office level is a good level of analysis. And also Asana and Kellikar have shown that if a client audit office has an increase in reputation, other clients in the same office will pay a free premium. That just having this client that's done better, in their case was being the S&P 500, says something about what the office can turn out. And so other people say, yes, I want to be associated with that. I'm willing to pay a premium to be there. And again, the fund that this is most heavily based on is Francis Mehta and Shao, where they say the links between gains and losses of major clients, the fees paid by the clients of the same office. And this paper is very much an extension, of this, and also in the Australian context. So the basic hypothesis is this one: the clients of an audit firm will pay a fee premium if the firm gains a large client at the office from which they are audited, and will pay a fee discount if the firm loses a large client at the office from which they are audited. And the clients, so that's the first step, is the office analysis. The second level is about the industry. And so the hypothesis 2A is about paying a premium if the firm gains a client at the national level of the industry in which the client operates, and a discount if they lose one. And then the second one is about the city level. Okay. And then the next two are about industry specialization. So clients audit firm will pay a fee premium if the firm gains a large client in the client's industry, and the firm's the national industry leader in the client's industry, and will pay a fee discount. And then, of course, 2B is then saying the city level analysis. So again, as I said when I was talking about the theory, the closer the client is to the gain or loss client, the more important it is. Okay, so methodology: sample of 10,822 ASX listed companies years 2011 to 16. And then I take two subsamples. The first one is I split it down to big six, where the big six is a big four plus BDO and Grant Thornton. The reason I've included those two firms is because I have as many clients in the sample as the big four. They're just not as large. They don't have the really big ones, but they do have as many. Out of that 10,822, the firm that has the most clients is actually BDO. So there's 6,870 in that restricted sample. And of course, because they've all got lots of clients, they're not going to be distorted by one unusual gain or loss. And the next group is 6,472 big six companies that did not change auditor, because one thing that will be driving the fee premiums and discounts, particularly the premium for gains, is what the gained clients are doing. So I've separated them out. And then again, I have to pick a threshold. What makes a client large? Now, of course, any choice is going to be arbitrary, but I've picked a $100,000 audit fee as being large. And, partially, that really is the top 20% or so of clients. So they are, reasonably significant. And also it gives me enough gains and losses for there to be an impact. So over that period, there's 450 client gains where the fee is over 100,000 and 480 client losses where the fee is over that amount. And of course, some of that will involve companies being taken over or collapsing or whatever else. And then I do two lots of robustness tests. The first one is I take a 1 period lagged response. So I say, well, what do changes last year influence this year? And the second one is then I say, well, I'll pick a bigger fee. I'll go to 200,000 and see what the impact of that is. So that's what I've done here in terms of structuring this. So let's have a look at what we got. So for the test of H1, I use a standard audit fee model with the usual controls. And I add two variables. Office gain takes a value of 1 if the client's audit firm has gained a large fee greater than 100,000 client during the current year, in the office from which the client is audited. And office loss takes a value of 1 if their large client fee greater than $100,000 has been lost from that office. Now, of course, if you're gaining and losing at the same time, that's going to, the effects may cancel each other out. If I gain A limited and lose B limited and they're roughly the same size, well, what have really happened? So I've defined these gains and losses as being exclusive. So office gain means you gained and did not lose a large client. Office loss means you lost and did not gain a large client. And there's the model. And you can see, it's pretty standard. For T2, I have national industry gain, national industry loss takes a value of 1 if the firm gains or loses a client in the industry with a fee of over $100,000. So if you're a mining company and they gain or lose a mining company that's that big, does that affect the fee premium you pay? And then the city level ones are again if they gain or lose in the city in which you're based, $100,000. And so there's the models. So I've just put all 4 variables in there. Obviously, when I come down to it, I'll put them in individually. So for test of hatred, it's the same principle. So do you, if they're a national leader and they gain a client in the industry in which you operate, will you be willing to pay a premium? If they're a national industry and they lose that, we know there's a premium for national industry leadership. Firms are willing to pay for it, but is their premium affected by gains or loss of clients, large clients? And the same at the city level. If they're a city level industry specialist in the city you're in the industry you're in, and they gain or lose a client, well, what does that do? I mean, some effect saying is the premium city level or national level leadership premium impacted by these gains or losses. So there's a model, nothing special. So here are the descriptive stats of these variables. And you can see for the office gain, office loss, it's about 1 out of 6 for the whole sample and about 10% for the Big 6 sample. The Big 6 restricted is a bit higher. Again, once you start talking national industry, city level industry, it's about the same. So there are a lot of clients influenced by this. So it's a couple of thousand clients, or 1,500 to a couple of thousand. Of course, when you get down to the specialization ones, of course, it's much smaller because they've got to be a specialist to start with, and then they've got to gain and lose clients. But still, even in the very smallest cell, it's 241. So there is something going on there. I mean, there are enough observations for this to make sense. So if you look at hypothesis 1, so here's office gain and office loss, and you can see that in every case, there is a large premium for gaining clients. So it's highly significant. It's even more significant for the Big 6 sample. And most interestingly, when you leave out the gains, it's still significant. So clearly, gaining large clients is seen as a good thing. On the other hand, the results for loss are not as obvious. I mean, there's certainly overall a discount for losing large clients. But that loss, it's smaller, but still significant for the Big 6. But once you drop out the client changes, it becomes insignificant. And so what this seems to be suggesting is that, it's really the smaller firms that suffer a reputation loss for losing big clients. And as we get further into this, I've got an explanation for why that may be. But certainly hypothesis 1 holds for the large ones, even, for the gains overall and for the losses for the small firms. So for hypothesis 2A, again, there's a significant gain for the whole sample and for the Big 6 sample if they gain a client in the industry. So other clients in the industry willing to pay a premium. But this is not significant when the gains are left out of the Big 6 sample, which suggests that, the gain premium for Big 6 is largely paid by those gaining clients and not by the other ones. So they're paying to be audited, but the non-Big 6 aren't. Whereas for loss, it's insignificant for the whole sample. Losing a client in the industry doesn't seem to match, but what you note is that it is significant for the Big 6 and even more so for the Big 6 restricted sample. So firms that are losing clients are actually being rewarded for it, the Big 6. If they lose a client in an industry, they can charge a premium to their other clients. Now, that may suggest some of these losses are actually due to client failures where they may be paying a discount. But it does seem to suggest that there is actually a bit of a fee premium for pruning your client portfolio. We all know that the Big 6 do this. They periodically will throw out clients they don't want to be associated with anymore, because they're, well, maybe they're late payers, but also maybe they've got going concern issues or fraud issues. And so they seem to be rewarded for this. That it's better to have a slightly smaller but better portfolio. The market seems to be willing to pay a premium And part of what makes the big six better seems to be the fact that they're willing to ditch these clients that aren't worth having anymore. So 2B is about the city. And again, it's the same pattern, that there's gains for picking up these large ones, but at the big six level, they seem to be paid by the firms that are gained. They're in effect willing to pay a premium to be included. But on the other hand, if you lose, there is actually if you lose a client in the city, in the industry, you do actually earn a fee premium. Again, supporting the fact that there's a reward for pruning these clients that you don't want to be associated with anymore and supporting the firm's activities. So for hypothesis 3, if you look in the paper, I actually first of all put the national leader and the city leader in separately, and then I put them in together. Now I've also in this table included nat leader and sit leader. And this is important because it shows quite interestingly that when you include these variables, sit leader becomes insignificant, but nat leader stays significant. So there's a fee premium for big four firms that gain clients in industry with a national industry specialist. And there's a weekly statistically significant fee premium for big four firms that lose a client in industry where they're a city level industry specialist. Now I'll go back there and you can see those results. This is the last column, columns 2 and 3. Now they hold the restricted sample, which indicates it's not just gaining and losing clients. But the interesting point here is that when you include the gains and losses, the national industry leadership premium stays significant, but the city leadership premium disappears. So this suggests the national leadership premium is driven by enduring gains, enduring skills, that you've got databases, you've got training, you've got these things. Whereas the city leadership premium seems to be more driven by what you do with your client portfolio, and a couple of gains or a couple of losses can really explain what's going on with that premium. It suggests city leadership and national leadership are explained by different things. It also provides additional support for the idea that there are fee premiums for client pruning. That again, just as I've shown with the prior two hypotheses, that client management is important for the big six firms. Okay, the robustness test, I haven't put the tables on these slides, but they're in the paper. So if you have a lag, if you say, do last year's gains and losses affect this year's fee premium? Well, the results are in a similar direction, but they're much weaker. And this does suggest the market does react fairly quickly. And remember, this may be a whole year, but still, it doesn't require a period lag. When you put the fee premium up for $200,000, so you get a much smaller number of clients, about half the number of clients changes are impacted. So what you find is the effects largely disappear for the whole sample, but are stronger for the big six sample. Again, these results are in the paper. And this reflects the fact that non-big six firms don't gain or lose 10 million clients at this level. And so there's not that much going on there. It's largely driven by what's going on with the big six. But the industry and industry leadership effects are more significant in this case. And this is an area where I think more research is required. Maybe what if it's 500,000, or maybe I should have different thresholds for both big six and non-big six, or maybe even break the big six down into big four and the other two. So there's clearly more to say here. So conclusions. For large client gains, there are fee premiums for officers that gain large clients, and these fee premiums are paid by the gained clients and by existing clients. And there are gains for both national and city industry gains, and gains for national and city industry levels fee industry specialists. But these only tend to be paid by the gained clients. They're paying to, particularly for the specialisation, I think they're paying for that. Whereas the clients are already there, aren't necessarily getting it. So on the whole, this suggests that gaining large clients is a positive quality signal to the markets, that clients will need to pay for them, that allow firms to charge a fee premium, and supports their endeavors to really get these big clients, that it is an effective strategy to concentrate on those larger clients. And if you look at what the difference is in the big four, or in the big six between the big four and the other two, is that the big four really seem to concentrate very heavily on getting the very big clients. Whereas BDO and Grant Thornton, realize they can't really compete in that space so much. And the large client losses. So there's a discount for losing large clients at the office level overall and for big six firms. But if you're looking at the leadership, industry leadership, that big six firms actually earn fee premiums if they lose large clients. And this suggests client losses are not caused, so much by disgruntled clients walking, but by the big six firms either actively pruning their clients, to improve their client portfolio, make it smaller but better, or by the fact that they are not so fussed. Some of these clients that walk, they're not too disappointed to see them leave. And so, when you think about the quality signal of losing a client, it's not as straightforward as you might think. I mean, in some respects, it is actually beneficial to these larger firms. Okay, so that's it. So I'll stop sharing that. And well, thank you very much for attending this. I think I'm just about on time. Yep. And so what I'm going to do is I'm going to, if I can see this, I'm going to stop recording. Thank you very much. We've got a couple of minutes left for me to take questions. I'll be, very happy to do so in the chat. Goodbye.